Okay, heroes, welcome back. We got a fun one for you today. Before we talk about earnings directions, we talked about earnings, how they are a really awesome strategy, not only for us to stay engaged in the market. Obviously, market engagement and market awareness are a huge factor in determining profitability for us, but also keeping us in the game, keeping us knowing what's going on. So earnings are an overnight binary event that see the expected move or the premium built into options removed overnight. Right? Now, that in itself, the idea of that is literally our bread and butter. It's how we make money. It's how we put food on the table. It's how we pay for all those fancy cars and horses and vacations, right? It's the fact that the expected move is greater than the average, right? And it turns out that that earnings, while overnight are a reduction in implied volatility, we're used to doing those types of trades over a 50-day period, right? We have a lot of confidence and we have a ton of data and a ton of studies that over a 50-day period, the expected move definitely overstates the actual move. As it turns out, as we showed in the last lesson, that even in the one day overnight, 1 day expected move, the expected move still does overstate the actual move, especially when we're talking about taking off our earnings trades, which we'll learn here in a second, as soon as the market opens. If we wait till later on in the day, it's going to be a less profitable strategy for us, right? So I want to know something, though, in earnings directions, right? Because people think the market always goes up. They say, hey, the market on average returns 7% year over year, right? The market always goes up. Just buy stocks now and stocks will go up, right? We know that that isn't true. Markets are random, especially when the risk-free rate of return is zero. It's really difficult to have any positive drift in the market, right? That's over time. Same thing with the expected move over a 50-day period. But we know for a 1 day period, again, it's overpriced, right? So is there this concept of, because stocks are always going up, that earnings moves and the moves after earnings are always going to go up with it? But is that true, right? And the truth is, learning this can also give us more confidence to be able to put on these strategies, which we'll learn in the next few lessons. So we know earnings are a profitable strategy. We also know that from previous lessons, selling into strength and buying into weakness is more profitable than following the trend, right? So we know selling puts into weakness is more profitable than selling puts into strength, right? Selling calls into strength is more profitable than selling calls into weakness, right? So we know this. We know that markets are cyclical. They ebb and flow. They go up or down, right? So can the price movement of the overall market of a day impact individual stocks' price movement, right? So is the trend your friend in earnings? Or should we be buying into strength and selling into weakness, right? So we did a study on those same stocks. So Apple, Facebook, Netflix, Google, Microsoft, Yahoo, Goldman Sachs, Bank of America, United Airlines, JP Morgan, right? So 2003 to present, as many earnings cycles as we can get. We noted how many up moves in earnings came after a positive day in the S&P 500, right? Is the trend your friend? Like, I don't know. Right? And then we noted how many down moves in earnings come after the S&P is down for the day, right? So again, this is the overnight expected move, and we want to see if earnings go up when stocks are up, or earnings go down when stocks are down, right? And here are the results. So when the S&P is up for the day, prices following earnings go up about 53% of the time, right? And they go down about 47% of the time, right? So this gives a slight edge to earnings going up if stocks are up, right? This gives a slight edge. If the S&P is down for the day, well, earnings are still up about 51% of the time, and they're down 49% of the time, right? So to me, this is in the wash. This is totally like markets are random, earnings moves are randoms, all that stuff, right? Which is nice because, again, we just saw in the last lesson that the expected move is still overstated to the actual move in the overnight binary event of earnings, right? And now this says to us, hey, there isn't really an edge. There isn't really an edge in terms of the market direction dictating earnings. So that's great. So we can just bet on these neutral strategies in terms of selling a strangle, for an example, on the expected move to be a profitable one. But let's take it a step further. So we're doing 2003 to present again. Apple, Facebook, Netflix, Google, Microsoft, Yahoo, Goldman Sachs, Bank of America, United Airlines, JP Morgan, right? So now what we want to do is we want to take it a little bit step further, right? So what we just saw was if the S&P was up, we want to know if earnings were up or down. If the S&P was down, we want to know if earnings were down or up, right? And again, it's just in these 10 stocks. However, these 10 stocks are on all of our watch lists. They're in the most liquid products in the world. We trade earnings on pretty much all of these type things. Now what we wanted to do is we want to test out extremes. As we know from all of our other strategies, the more extreme a move, the better our chances of making money and the higher P&L is. So the more stocks go up, the better we are at selling calls. The more stocks go down, the better we are at executing long bias strategies or bullish strategies, right? So we want to see not just how they do if S&P is up or down, but we want to see how they do if S&P is up or down 1% in either direction, right? So that's a large move. So let's see what they do, right? So if you guys have already seen this column right here, right? So if the S&P is up for the day, earnings are up about 53% of the time, they're down 47% of the time. Right, in the third column, when the S&P 500 is down for the day, earnings are up about 51% of the time, earnings are down about 49% of the time. Right? If the S&P is up over 1% for the day, actually it's a little bit better, not a lot, but a little bit better, about 4% better, right? So earnings are up. When the S&P is up more than 1% a day, the stock movement after earnings in these 10 stocks is up about 55% of the time. Okay, a little bit better, but not the edge I'm looking for. However, and this is the really interesting one, and this personally has made me a ton of money. If the S&P is down, right? Excuse me, this is just wrong. Sorry. If the S&P is down greater than 1%, and the S&P is down greater than 1% for the day, the direction of these stocks, these 10 stocks, the day after earnings is up only 22% of the time and is down 78% of the time, right? So if stocks are up or down, there's no edge. The only edge is when stocks are down and down big. So if the S&P 500 is down 1% or greater on a given day, the earnings, at least in these 10 stocks over the last 14 and a half years, have been down close to 80% of the time. So this is a really cool edge. Right, so there's some fun stuff. We know that the expected move is overstated for earnings, which are one-night binary events, right? We know that when stocks are down and down big, there's a big tendency to have the earnings follow, right? The price of the stocks after the earnings follow, especially to the negative side. Now let's get into some strategies to show you exactly how to take advantage of all of this.